Okay. Okay. I've received it. Yeah. So guys, I was talking about a standard, right? And I said we have attainable standard, right? And we have unattainable standard. The attainable standard are those standards that give room for idle time, right? For machine breakdown, right? Yes, that is attainable standard, right? And it is real, it is achievable. All right. Now we have another standard which is an unattainable standard, and that is a standard that it cannot be achieved. Why? Because it has what do we call it? It has it does not take it does not give room for idle time, machine breakouts. No, it's a perfect standard that 100%. There is no slack time. There is no 99%. Everything has to be 100%. All right. So that's what we have there. That's an unattainable standard, an unattainable standard. All right. So that's it. Right. Now, let's quickly go into, I'll still be sharing the material with us. All right. Let's just move on. Now, let's go into our material variance. Now, we discussed variance before, and we said some things will give us uh favorable and adverse variance, right? Now, those things that will give us favorable variance. Now, let's look at material variance. For materials variance now, like we said, we look at the quality of the product. The quality of the product will tell us if it is uh if it will give a favorable or adverse. All right. So that's it. Now, yeah, so I remember the remaining variance I was looking for. So the first one, like I said, is an ideal variance, and that is a perfect variance, right? And it is unattainable, unachievable. We have an attainable variance that is the opposite of that ideal. Then we have a current variance. Current variance, I mean, in standard, sorry. Current standard is a standard that is based on the current working condition, that is based on the current reality. All right. So current one is like the last standard you used. Do you understand? The last, let's say, standard you used in the last year. So you want to use that standard to set another standard for this year. That is the current standard. The standard you used last year is what you are setting standard for in this year as well. All right. That is a current standard. It's just like saying last year budget is what you are using as a basis. All right. Then the last one we have is a basic standard. So basic standard is the standard you have been using over time, not just last year, but let's say the standard you have been using in the last 10 years. Right. So the difference between basic and current standard is that basic standard is what you have been using over a period of time. It can even be 20 years ago, right? Why the current standard is the standard you used in the previous year, just the immediate uh year. That is a current standard. So these are the things we have here. All right. Now, any question from anyone? Any question from anyone? Go ahead, please.
Yes, sir. Can you explain the types of standard that you explained now again? Can you take it again?
Okay. So we have four different types of standards. The first one is the uh ideal standard. Ideal standard is 100% standard that says that you are setting it that you must achieve your target 100%. 99% is not allowed. All right, 100% only. Do you understand that? So that is an ideal standard. And of course, you should know that an ideal standard may not be possible. All right. So that is an ideal standard. There's no room for wastage. There's no room for spillage. There's no room for pilferage. There's no room for spoilage. There's no room for inefficiency. There's no room for machine breakdown. You not tell us that your generator, you ran out of fuel, or your generator broke down and you're waiting for mechanic to come and fix it. An engineer to come and fix it. No, you won't do that. All right. An ideal standard will not give room for all of that. Do we understand? So that is for ideal standard. Now, an ideal standard is definitely unachievable, unattainable. You can't attain it, you can't achieve it. To be very difficult to achieve. All right. Now, we have the opposite of that ideal standard, which is an attainable standard. Attainable. A standard that is achievable. All right. So this standard now is a standard that gives room. It's just the opposite of the ideal standard. All right. It's the opposite of the ideal standard. It gives room for machine breakdown, idle time, wastage, inefficiency, and all of that. It gives room for all of those things. Okay. Then the next one we have is a current standard. Current standard is the standard you used in the last year, in the immediate last year. Please hold on a second, guys. Hold on a second. Just 1 second. Hey, let me even share my screen now. Instead of me alone looking at the screen, let me share the screen, please. Please confirm you can see my screen now.
I can, sir.
Please confirm. Okay.
I cannot see it.
I can't see it too.
Okay.
So we can't
So
see you.
now, the current standard, like I said, sorry, may I proceed, please?
Yes, sir.
Okay.
Yes.
Now, the current standard Ma, what do you say, please? Okay, let me proceed. So the current standard is the standard for last year, or the standard that you are currently using for this year. What you base your budget for this year on, right? That's the current standard. Okay. Why the last one we have is basic standard. And basic standard is the standard you have been using over a period of time. All right. So that's what we have there. Now, for variance, we have material variance, we have labor variance, we have overhead variance, variable overhead variance, fixed overhead variance. What again? We have revenue variance, right? And sales variance, sales variance. Yes, go ahead, please. That person should go ahead. Speak.
Sir, can you please zoom your screen?
I should zoom, okay.
Thank you, sir.
You're welcome, sir. Okay. Now, for material variance, we have, so let me give you one expo. I don't know if Mr. Ibrahim is on this call. Let me give you one expo on this. If you look at the material variance, you will see AA, AS, and SS, right? Right? Can you hear me, please?
Yes, sir.
Yes, yes,
Yes, we
yes.
can
Yes,
hear
we
you.
can hear you, sir.
Let me let me tell you one secret. Let me tell you one secret. You see AA and AS, and I'll tell you, Mr. Ibrahim prepared this material, right? And I'll tell you his source. Let me tell you. I will tell you this night. Now, AA and AS is the name of two of our lecturers at the Polytechnic Ibadan. And this is the style they used in teaching us variance in school. So that is what Mr. Ibrahim has adopted, because it is very simplified, and he has decided to use that for you guys. And trust me, if you understand these three, if you understand this logic, both your basic variance and the advanced variance, you'll find them very, very easy. You will not need to memorize the formula anymore. You will not need to memorize them. So that's what he has done here. Now, so yes, by the way, me and Mr. Ibrahim, we attended the same school, the same higher institution. So that's it. Now, material variance. Material variance is divided into two, right? We have the material price variance and material usage variance. I believe you all know that, right? Yes, right?
Yes, sir.
Okay. You will not tell me it's your first time of hearing variance. So that's it. Now, material price variance. We can now have material price variance and material usage variance. Material price variance is the price, the difference between the standard price and the actual price. While your material usage variance is the difference between the standard quantity you are supposed to use and the actual quantity you have used. Okay, so that's that. Then also, so now for the formula, you can see AA, AS, and SS, right? Now, just like I said, we have two lecturers in our department who are using that initial, and the two of them have the same surname. The two of them are Adekola. We have AA Adekola, no AS Adekola and AA Adedeji. Yeah, we have the two of them, right? Now, these two guys, in fact, they are the two HODs. They followed each other. The first was the HOD. Adedeji was the HOD before. You guys, if you remember their name, we now have AA, we have AS, and we have SS. All right. Now for your material price variance, we take AA and AS, but don't forget we are bringing it from the ground below, right? We are taking it in an ascending order. So AS and AA is for material price variance, while SS and AS is for material usage variance. All right. While AA, you can see my cursor, right?
Yes.
Can you see my cursor? While
Yes, sir.
this AA and SS, the two of them are for material cost variance. Material cost variance. All right. So that is it. Now, like I said, for material price variance, now we are saying AS and AA, right? So don't forget, in material price variance, we are looking at the difference between the standard price of that material and the actual price of the material, right? Then you have to multiply everything by the quantity. Now, I said something when we were preparing our flexed budget, for those of us who remember. Now, I told us that when you are flexing your budget, you take the standard price with the actual quantity. I don't know if anyone remembers that. Does anyone remember that? Oh, none of you attended budget. Abi, let all of us be forming. None of you attended budget, right? Oh yeah, now we'll fight again. We'll come back and fight again. So that is that. All right. Standard price multiplied by actual quantity. Now, what are we saying in essence? If you are looking for price, that means you are multiplying it by the actual quantity. When you are on usage and you are looking for quantity, you will multiply it by the standard price. Oh, I don't know. I don't know if you understand what I'm saying. When you want to get the variance between the material price, you are looking at the difference between the standard price and the actual price. Am I right? Am
Yes,
I
sir.
right?
Yes, sir.
So now, ordinarily, you have to, before you can know what that variance is in total, you have to multiply it by quantity, right? Now, I'm telling you that whenever you are dealing with quantity, then you are dealing with actual quantity. But whenever you are dealing with price, let's say you want to do material usage variance, that is standard quantity that you are supposed to use minus the actual quantity you have used, right? Then that one, you are multiplying it by the standard price. That is what it simply means. All right. So now this AS and S and AA, which is for material price variance, it is AS minus AA. Now I usually put quantity on each of them. Quantity, 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 quantity. That is actual quantity times standard quantity, right? Oh, sorry. Please, are we together?
Yes, sir.
Hello?
Yes.
Okay,
Yes.
so it should be
Yes.
quantity and price. Quantity and price. So actual quantity times standard price minus actual quantity times actual price. So which means AS minus AA will now be actual quantity multiplied by standard price minus actual quantity multiplied by actual price. What am I saying in essence? Right? So what I'm saying in essence is this. I don't want to use this side. Okay. So let me bring, I hope you can still see my page, please.
Yes, sir.
We can see my
Yes,
page, right?
yes.
Okay. Now, I said we have it to be AS minus AA, right? And I'm saying that on this AS minus AA, let me have it to be quantity and price, and this one also to be quantity and price. All right. So what am I saying in essence? A, don't forget it's still AS and AA. Abi, now when you see AS, it means A times S, right? Am I right?
Yes, sir.
Hello. In mathematics, when you see AS, it means A times S, right?
Yes, sir.
Now, what I'm saying in essence is now, instead of doing that AS and minus AA, right? I put Q and P under each of them. QP, QP. So what am I saying in essence? I'm saying that AQ, which is actual quantity, multiplied by standard price. Does that make a sense? Does it make a sense, please?
Yes, sir.
Yes, sir. Yes, sir.
Yes.
Then this minus, I put it here again, minus actual quantity multiplied by actual price. This is your formula for material price variance. All right, material. Oh, so let me put it here. Let me start from the beginning. So for material price variance, do you understand now? So my material price variance now is actual quantity times standard price minus actual quantity times actual price. Now, if you look at this, these two brackets, something is common between them. What is common?
Actual.
What is common between the two?
Actual
Actual.
quantity.
Actual count.
Actual quantity.
Actual quantity is common, right? So which means I can easily say that standard price minus actual price, right, multiplied by actual quantity. Does this make a sense? Does this make a sense now?
Yes, sir.
Yes, sir. Yes, sir.
So that is your material price variance. Now, your material price variance, you can bring it from here. You can use this one. You can use this one. Now, the question will determine which one to use. But most times, this last one is most times. I said most times, not all the time. The question will determine. All right. So that's it. So you can see that from the AS and AA that Mr. Ibrahim gave us here, AS, AA, AS, and SS. All right. So that's the expo. You will not see this thing in any other material. That means this tie is for Mr. Ibrahim only. You will not use it outside. We will have a copyright over it. It's for Polybaron products only. If you didn't attend my school and study accountancy, then you can use it for your class and for your exam, but don't write a book on it. Anyways, I'm just kidding. So that's it. All right. Now that's for material price variance. Now for material usage variance, we said it is SS and AS, right? Can you see? Material usage variance is SS and AS. Am I right? Am I right, please? Hello?
Yes,
Yes,
sir.
sir.
Yes, yes, you are right.
Yes.
Yes, sir.
Yes,
Okay.
sir.
Yes, sir. You're right.
So let's do the same thing for material usage variance. Material usage variance. He said it to be what? SS minus what? AS, right? Am I right, please?
Yes.
Yeah,
Yes, sir.
someone go ahead, please, Mr. Deborah.
Sir, sorry, you were talking about the material price variance, and you said is actual quantity times standard price, then minus um actual quantity times standard actual price. So where is the actual quantity
Yes,
in
please.
itself? Because I was thinking it's supposed to be standard quantity times standard price minus actual quantity times actual price. I don't know if I'm wrong.
Say it again, please. Let's write it out. Say it
Okay, so I
again.
said I was thinking it's supposed to be standard quantity times standard price
Uh-huh.
minus actual quantity times actual price.
Minus actual quantity times actual price, right?
Yes, sir.
Eh? Okay. So you see this one that you have done, eh, is for material cost variance. And you will see it here. Let me show it to you here. I said SS minus AA is cost. Look at it here. SS minus AA. Standard quantity times standard price minus actual quantity times actual price. That is material cost variance, not price.
Thank you, sir.
You're welcome, man. All right. So, guys, that is that. Now, for our material usage variance, right? I said SS minus AS. Is that what we have here?
Yes,
Nobody's
sir.
talking. No. Okay,
Sir.
so if
Yes,
that is
sir.
what we
Yes,
have
sir.
there,
Yes.
now just like I said, I also had QP and QP under each of them, right? I'm also adding QP and QP under each of them. All right. Now, what does this one give me now? It will give me what?
SQ
Standard
minus
quantity.
SQ.
Standard quantity.
SQ
Don't use
minus.
SQ, please. Use the
Sorry.
word so that you can get used to it.
Okay.
All right. Standard quantity times standard price, right? Minus what?
Actual quantity times standard price.
Minus actual quantity times standard price. All right. Now, something is common between the two brackets. What's that?
Standard price.
Standard price.
That price.
So, which means I can easily say that standard price is common, right? So, I can say standard quantity minus actual quantity multiplied by what?
Standard
Standard
price.
price.
Standard price.
Multiplied by standard price. Now, you can see what I said earlier, that when you are dealing with usage, which is quantity, you multiply it by the standard price. But when you are dealing with price, you multiply it by the actual quantity. Does that make a sense, please?
Yes, sir.
Uh-huh. So this is what you have here. All right. Now, you see what you have done for this material. You replicate the same thing for labor and overhead. All right. Now, this is for material usage variance. Now, let's go into our material cost variance. So, for material cost variance, and don't forget, material cost variance is the addition of both price and usage variance. Abi, am I
Yes,
right?
sir.
Okay. So, for our material cost variance now, material cost variance will now be, we have it in our formula here to be SS and AA. Abi, am I right? SS
Yes, sir.
minus,
Yes, sir.
you can see the arrow here, right? You can see the arrow here. SS minus AA. All right. And that is SS minus AA. Just like I said, I'm adding QP under each of them, right? I'm adding QP under each of them. And what would that give me? Standard quantity times standard price, right? Am I right, please?
Yes, sir.
Right? minus what? Actual quantity
Quantity times
times
actual price.
actual price. Is anything common in this bracket?
No,
Is
no,
there
no, no.
anything
There's
common
nothing
in the
common.
bracket?
No,
No.
There's
sir.
nothing
No,
common.
sir.
No, sir.
So that means you will not have any. That's why in your material cost variance, you will not see standard minus actual multiplied by no. Usually you will not see it like that. All right. So this is what we have for material price variance. Now we go into labor variance. Labor is not using price and quantity. I mean, for labor, we don't use labor price. Do you call it labor price?
No, sir. No.
No.
Instead, what do we call it?
Rate.
Rate.
Labor
Labor rate.
hour.
Labor rate. Labor rates. Instead of
Rate.
price, we call it rate. Right? Now, instead of quantity, you measure labor payment. You don't measure it with quantity, you measure it in hours. All right? So you measure it in hours. Instead of the way you measure material quantity and cost or price, you measure labor in both hours and what? And what, please?
Rate. And rate.
Thank you, sir. And rate. So that's what we have there. All right. Now, the same thing applies to labor. So you can see we still have the AAAS and SS. The same thing applies. Okay. So yes, but instead of doing what do we call it? Let me take this. But instead of having what do we call it earlier? Uh price
Price.
and quantity,
Quantity. We have
right? So
rate.
this is so for labor now we have it to be labor what?
Labor rate
Labor rate
variance.
variance, right? So for our labor rate variance, we still have it to be AS and AA. Abi? Now, instead of having quantity and price, this one will be what? Quantity will now be what? Hours. Abi?
Hours
And
and
price will now be what? Rate.
rate.
Right? So this one also will be hours and rate. Do you understand, please? Now, it means that for this one, I will have actual hour multiplied by standard rate, right? Minus actual hour multiplied by actual rate.
Actual.
Am I right?
Yes, sir.
So what is common in this bracket now?
Actual hour.
Actual
Actual.
hour is
Hey.
common.
Actual
So which means
hour.
I can have standard rate, right? Minus actual rate multiplied by what?
Actual hour.
Actual hour. Now, just like I said, for quantity, you are using actual quantity. Hour is representing quantity under labor, right? Hours represent quantity under labor. Do you understand? Hello?
Yes, sir.
Yes, sir.
Aye,
Yes,
aye.
sir. We
Yes, sir.
understand.
You understand what I'm saying, right?
Yes, sir.
Okay. So that is it. Now, the same thing. That's for labor rate variance, right? The next one we'll be having is what? Labor efficiency variance.
Yes, sir.
Abi?
Yes, sir.
Abi?
Yes, sir.
Labor efficiency variance. And that one will give us what? What do we have there? SS minus AS, right? SS minus AS, right? And I said this one also use HR, which is hours and rate, right? So what do we have? Standard
Standard
hour
hour multiplied by
multiplied by
standard
what?
rate. Standard rate
Standard rate, right?
minus
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 what?
yes,
actual hour
Actual hour
Actual
multiplied by
hours
standard rate.
multiplied by standard rate.
standard rate.
actual hours multiplied by standard rate,
Rate.
right? And what will that give us? Something is common. What's common here?
The
Standard rate.
standard rate is common.
So that means I have
Standard
standard
hour
hours
multiplied
minus actual
Minus
and
actual
hours
hour
standard rate.
multiplied by
multiplied by
what?
standard
Standard
rate.
That rate. The same thing I said about material price variance. You use standard price, not actual price. In the same vein, you use standard rate, not actual rate. Do you understand? Actual hour, actual quantity. Standard rate, standard price. All right. So that is what we have here. And then our labor cost variance is what? Labor cost variance will give us what? SS minus AA, right? Am I right?
Yes, sir.
Yes, sir.
Okay. SS minus AA. And under it, we have what? HR, hours and rates, right? And hours and rates. So what does that give us?
Standard
Yes.
hour
Standard hours
multiplied by standard rate.
multiplied by what?
Standard
Multiplied by
rate
standard rate
Standard rate.
minus
minus what?
Minus
actual
Actual
hour
Actual hour
multiplied by actual rate.
actual rate. Is anything common in the brackets?
No, sir.
Yes, sir.
No.
Nothing
No,
is
sir.
common, you.
Nothing.
So that is your labor cost variance. Any question from anyone? Any question from anyone? Okay. Now, please, your variable overhead, we also have the same thing. Don't forget, variable overhead uses something similar to labor, right? Your variable overhead most times is either on machine or labor. Your variable overhead is either on machine or labor. In the same vein, your labor hour can be on machine and it can be on human. I hope you understand that. When you're talking of labor cost, the labor cost might be the cost you are spending on machine, right? So please, let's take note of that. And that's what we have there. I hope we can proceed now.
Yes.
Yes, sir.
Yes,
Yes,
sir.
sir.
Okay. So for sales variance, we have sales variance to be standard selling price minus actual selling price times actual quantity sold. Standard selling price minus actual selling price multiplied by actual quantity sold. All right. So that is that. Now, and of course, you can also have your material variance. Your sales variance can be sales price, which is that standard selling price, right? And also you can have the sales volume variance, which is the standard sales unit minus the actual sales unit multiplied by standard contribution, not standard selling price. Hello. For sales, now for sales variance, sales price variance, we say standard selling price minus actual selling price times actual quantity sold. But for the volume will not be times standard selling price. No, it will be times standard contribution. And where do you use contribution? When you are using marginal costing, Abi, Marginal costing is the one that will tell you that your sales minus variable cost will give you contribution. Am I right? Am I right?
Yes.
Yes, sir.
Don't
Yes,
tell
sir.
me
Yes,
you're
sir. Yes, sir.
forgotten. I'm very sure Mr. Ibrahim taught you. Then, but if you are using an absorption costing, then you'll be using standard profit, not contribution. Standard profit. All right. So that is what we have there. Now for fixed overhead variance, now this fixed overhead variance has a variance that is far different. In fact, your AS, AA, AS, and SS will not work. It will not work for two variances. It will not work for sales variance, of course, right? It will not work for sales. You can still crop it to work for sales variance, right? But it will never, ever work for fixed overhead variance. Do you understand? It will never, ever work for fixed overhead variance because now your fixed overhead variance is earlier. If you remember something earlier, I was telling you about the difference between standard price and budgeted price. Abi, am I right?
Yes, sir.
Yes.
Yes, sir. Correct, sir.
Your fixed overhead variance made use of the three of them. Your fixed overhead variance is that variance that made use of standard price. I mean, yes, standard price, budgeted price, and actual price, or standard hour, budgeted hour, and actual hour. Your fixed overhead variance made use of that. All right. Now, for fixed overhead variance, it's divided into two as well, right? Don't forget, because it is a fixed overhead, that means there's something called OAR, overhead absorption rate. Do you remember under your absorption costing? Do you
Yes,
remember
Yes.
your
sir. Yes, sir.
OAR?
Yes, sir. Yes, sir. Yes, sir.
Yeah. You see, that OAR is what we have here. So instead of using standard price, you'll be using overhead absorption rate. We use it for variable overhead too. Variable overhead variance. Variable overhead absorption rate. All right. So instead of calling it standard price, you will not call it standard price. You will call it under variable overhead, you will call it variable overhead absorption rate. And for fixed overhead, you will also call it fixed overhead absorption rate. It will not be standard price. All right. So that's it. Now, and of course, when we're doing our overhead absorption costing, we have either over absorption or over absorbed or under absorbed. Abi? Now, fixed overhead variance is the difference between fixed overhead. Now, the general variance is the difference between your budgeted fixed overhead variance and the actual fixed overhead variance. Watch take note of it. Budgeted and actual. I did not say standard and actual. Do you understand me, please? This is where I'm reading from. Fixed overhead expenditure variance. For the expenditure, don't forget your expenditure. Now, let me explain why we are using budget for this one. Fixed cost is fixed regardless of the level of activity, right? Am I right?
Yes, you're
Yes, sir.
right.
Yes, sir. Yes, sir. Yes, sir.
Yes, sir.
Come rain,
Yes, sir.
come sunshine. Fixed cost is fixed cost, right? So that one is not what it ought to be. It is the budget. It is the standard. That standard is your budget. It is not, you will not call it standard. Standard is how much am I supposed to spend on diesel if I am working for number of hours. Once you place it on number of hours, it means it is variable. Am I right? When I say that, how much fuel will I incur on my generator, if I'm working on so number of hours, that means I have fluctuated it. I have made it vary, right? I've varied it based on the number of hours. But whether we produce or you don't produce, your fixed cost is your fixed cost. Am I right?
Yes,
Whether you
bro.
produce for 2 hours
Yes, sir.
or you produce for 24 hours, your fixed cost is your fixed cost. That is why you will not call a fixed cost a standard. You will call it a budget because it is fixed. So now your fixed overhead expenditure variance is the difference between that budgeted fixed overhead expenditure and the actual. That is on the expenditure, the monetary aspect. But fixed overhead volume variance is the difference between the actual volume and the budgeted volume. On volume variance now, the actual volume, don't forget it is fixed. Actual volume and budgeted volume, you now multiply it by the FOAR, fixed overhead absorption rate. That's OAR that you did. How do we get overhead absorption rate? Anyone? How do we get it? What's the formula for overhead absorption rate?
Budgeted
The
overhead over
cost,
budgeted level of activity.
cost divided by quantity.
Budgeted overhead divided by budgeted level of activity.
So the two of you are right, actually. The budgeted overhead is in cost. The budgeted overhead that you have mentioned. So that's why it is not budgeted overhead. It is total budgeted overhead cost. So he mentioned cost, you mentioned budgeted overhead. And it's actually the two of them is the same thing. Total budgeted overhead cost divided by the total level of activity that is incurring that cost. Do we understand? So now that same overhead absorption rate is what you need here. That's how to get this FOAR, fixed overhead absorption rate. Right? So you're saying that this one is actual volume. Now you can say, well, okay, this one is a mistake. It's not a price, so it's not the price, right? Actual volume minus the budgeted volume times FOAR, right? Now, also, our fixed overhead volume is divided into efficiency and capacity variance. Abi? Efficiency and capacity variance. That one is the advanced part of it. So for efficiency variance now, it's the difference between the number of hours that actual production should have taken place. Right? Number of hours that actual production should have, which is standard, should have by standard. Actual number of hours you should have spent, the number of hours you should have spent on this actual production, normal. If nothing happens, the number of hours you should spend on this production, that is a standard, right? And the number of hours you have actually spent, that is the efficiency. So if I want to check whether you are efficient enough or not, how many hours are you supposed to work? How many hours did you work? Multiply by that same fixed overhead absorption rate. All right. So you can see this one is standard hours minus actual hour. There is another way. I'm coming to it. Then also we have fixed overhead capacity variance. Capacity has to do with what did you do? Right? Capacity is what you can claim. No. Capacity is what you can do. No, capacity is what you can accept. Capability is what you can give out. Yes. Capacity is what you can accept, what you can absorb internally. Capability is what you can dish out externally. All right. So your fixed overhead variance is the difference. Capacity variance is the difference between how many hours did we budget for. Budget, not standard. Standard is how many hours are we supposed to use on this thing. But this one is capacity. What was our capacity? Capacity is we can produce at 60% capacity. That is, we can work at 60% of what we can do. Right? So budgeted hours. That's the number of hours we have budgeted. We can work for 60 hours. We can work for 24 hours. In a particular day, we can work for up to 20 hours. That's our capacity. And the actual hours worked multiplied by that same fixed production overhead absorption rate. All right. So when you see standard absorption rate, it is still known as the fixed production overhead absorption rate, because that standard rate is OAR. Abi, budgeted overhead divided by level of activity. So that is still the FOAR. So if you look at it very well, your capacity variance is talking about budgeted hours and actual hours. Your efficiency variance is talking about standard hours minus actual hour. But your volume variance is talking about standard volume minus actual volume. Right? Aha. So that is it. Now, there's another way we can solve this fixed overhead variance. Do you remember efficiency ratio, capacity ratio? Who remembers that? Efficiency and capacity ratio. Is anyone on this call? Or am I the only one here?
Yeah, with you, sir.
I asked the question. No. Efficiency and capacity ratio. Mr. Motayo, that your laughter. Efficiency and capacity ratio. Can we remember that? Efficiency ratio, capacity ratio. We can't remember. I didn't think you can remember. I would have taught you how else. Now, that efficiency and capacity ratio, let me just bring it out. Efficiency and capacity ratio can also be used to solve efficiency variance and capacity variance. All right. So that is just that. So efficiency ratio, activity ratio, and capacity ratio. So that's what we have here. Any question from anyone? Any question from anyone? In the absence of question, let's go to November 2014 question on variance. November 2014 question on variance. Let's see if we can quickly finish that before we go into what do we call it? Advanced variance. Now, for your advanced variance, we are using the same formula. When we get to advanced variance, you will see it. We are using the same formula, the same acronyms. November 2014, please. Can someone open that? November 2014. Has anyone seen it?
Yes, sir.
Okay. So please help us with what you have. Page 63. Question 1. No. Question 2. Yeah. Shall we proceed, please? Someone should please read the question for us. Someone should please read the question. Is anybody there?
Yes, sir.
Someone should please read, though. Go ahead, please. Go ahead,
Ibex
though.
Limited manufactures a standard product and operates a system of variance accounting using a fixed budget. Okay, so required. The operating required A. The operating statement for the month ended 31st December 2013. B. That's BI. Direct material cost variance. BII. Direct labor variance. III. Overhead variance. IV. Sales variance. The question proper. eBay Limited manufactures a standard product and operates a system of variance accounting using a fixed budget. As a newly appointed management accountant, you are responsible for preparing the monthly operating statement. Extract from the budget for the statement for the standard product cost, and actual data for the month ended 31st December 2013 are given below. Budgeted and standard cost data. Budgeted sales and production for the month 20,000 units. Standard cost for each unit of product. We have the budgeted direct material A and B. We assume all figures are correct. Fixed production overhead is absorbed at 200% of direct wages. Budgeted sales price has been calculated to give a margin of 20% of sales price. Actual data for the month ended 31st December 2013. Production 19,000 units sold at price of 15% higher than the budgeted. Then we have direct material column. We assume all figures are correct. Direct wages included 92,000 hours at 6 naira 40 kobo per hours. Fixed production overhead incurred 580,000 naira. You are required to A. The operating statement for the month ended 31st December 2013. BI. Direct material cost variance. II. Direct labor variance. III. Overhead variance. IV. Sales variance. So I'm done.
Yeah, I know. I'm trying to unmute myself. So the first one we have on the variance, we have to do direct material cost variance, right? So how do we,
Yes.
yes, who can solve our material cost variance? What would be our material cost variance? Anyone? Material cost variance, who can do it for us?
That's SS minus AA.
Uh-huh. SS minus AA, yes. What do we have there?
Then we have our standard quantity times standard price minus actual quantity times standard price. So since our standard price is common, we should not have standard quantity minus actual quantity times standard price.
Does anyone understand what he has said? And is it correct? Is it correct?
Yes, sir.
Ah,
It's not so
someone
material.
said it's correct.
That is material for standard cost. It should be standard quantity times standard price minus actual quantity and actual price.
So thank you, sir. I did hear with you, I don't know before. So for your material cost variance, it is standard quantity times standard price minus actual quantity times actual price. Do you understand, please? Standard quantity times standard price minus actual quantity times actual price. That's what we have for material cost variance. Please hold on, guys. Hold on a second, please. Sorry about that, guys. I hope you can still hear me.
Yes, sir.
We can hear me, right?
Yes, sir.
Okay. So for our material cost variance, we said standard quantity times standard price minus actual quantity times actual price, right? Now in the question, let's look for what our material, please. When you're solving for material, don't go and be looking at label. Do you understand? Do you understand, please?
Yes,
So
sir.
now, so they gave us the question here. They said sales and production for the month is 20,000 units. Standard cost. Now you can see the question gave you standard cost for each, not budgeted cost. You can have a budget, but it's still different from actual and standard. Okay, so that's it. Now, for material variance, now for standard quantity, what is the actual unit we produced? What's the unit we produced? How many units did we produce? Production this time now,
19,000.
19,000 was
19,000
produced.
units.
19,000 was produced. Now, we want to see if I am to produce 19,000 units, how many materials do I need to produce one unit? Do you understand? Two materials in this question. We have material A and material B. We add them together. Now, for material A, if I am to produce one unit, I need 10 kg. Am I right? Am I right, guys?
Yes,
Yes,
sir.
sir. Yes,
Now,
sir.
if I'm to produce one unit, I need 10 kg. Now, if I am to produce 19,000 units, how many kgs do I need? That's 10 kg times 19,000 units. Abby, am I right?
Yes, sir.
So, if I am to produce one unit, I need 10 kg. If I'm to produce two units, I need 10 kg times 2, which is 20 kg. If I'm to produce 50 kg, if I'm to produce 50 units, I need 10 kg times 50, right? In the same vein, if I am to produce 19,000 units, I will need 10 kg times 19,000. That is standard, not budget. Does that make a sense, please? Does it make a sense?
Yes, sir.
Okay.
Yes, sir.
So that is standard. That is what I need. And
Please come
for my
again, sir.
material now, if I'm buying the material, I'm buying 2 naira per kg. Abi? So which means automatically for my material A, I'm looking at the standard and the actual. Abi? Standard price times standard quantity. Abi? Am I right? So what's my standard price for material A? Let me do for material A first. Let me use this page. November 20 what? 2014, Abi?
2014.
Question 2. Question 2.
November 2014, question 2. So material cost variance. What do we call the material cost variance? SS minus AA. Abi? And since it is under material, we have it to be quantity and price. Abi?
Yes, QP.
Quantity and price. And this one says what? Standard price multiplied by standard quantity, right? Standard quantity multiplied by standard price, right? Minus actual quantity multiplied by actual price. Abi? So let's do for material A. For material A now, what's my standard quantity? Standard quantity is the quantity that will produce 19,000 units. Abi? So it means my standard quantity will now be 19,000 units multiplied by 10 kg. Abi? Am I right?
Is it 10 or 2
Am I
naira?
right?
Yes, sir.
Standard quantity. Standard quantity is 19,000 units multiplied by 10 kg. 10 kg will give me 1 unit.
Yes, sir.
Right? So if I'm producing 19,000 units, it will be 10 kg times 19,000. That will give me how many? That will give me what?
190,000.
That will give us 190,000.
None of you has answered my question.
kg.
And the question, see,
190,000
One
kg.
kg.
Hey, that is exactly what I want you to answer. Will the answer be in kg or be in unit?
kg.
In kg. So I'm saying that one kilo of rice will feed 2 of us. How many kilo of rice will feed 10 of us? Do you understand?
Yes, sir. 10 kilo.
So that is what it simply means. So the answer will be in kg. That is 190,000 kg of material A. That is the standard quantity. Abi?
Yes, sir.
So standard quantity, let me use this for it. Standard quantity multiplied by standard price is what? 2 naira for 1 kg. Abi? Am I right, guys?
Yes, sir. 2
Yes,
naira.
sir.
Okay.
So 2 naira. Please, when you are doing variance, please, where you are supposed to write unit, write it. Where you are supposed to write kg, write it. Where you are supposed to write naira, write it. and make sure you understand each of them. Now, your inability to understand it will put you into trouble. For instance, now, when I said 19,000 units times 10 kg, if you had answered that the answer will be 190,000 units, then you know that you're already in trouble. Do you understand? So you need to understand which one. Is it in kg or in units? All right. So let's move on. Now, that is our standard material, standard quantity times standard price. Abi,
Yes,
am I
sir.
right? Now,
Yes, sir.
actual quantity times actual price. Please take notes. That one can be given to you. Hold on, we are coming. Hold on. All right. Now, your material cost variance, will your answer be in price or in quantity? Before you answer that question, that person who is raising up his or her hand, please go ahead with your question.
So I just want to ask that why are we doing 19,000 times 10?
So we are actually
We
looking
get the
for
standard cost.
the standard quantity at the standard price. So 19, the formula is standard quantity. So if 10 kg, we produce 1 unit of our product, what is that product, Seth? Did not tell us the product. Let us give it a name. What could be that product, please? Someone should give us the name of the product. Let's say a cupcake. No, 10 kg is too much for cupcake. Let's say a standard birthday cake.
Bread.
Bread. Oh my God, we bless you. Thank you. Bread. Right? So 10 kg will give us 1 loaf of bread. And we want to produce 19,000 units of bread, 19,000 breads, 19,000 loaves of bread. How many kg do you think we'll use? How many kg of flour do you think we'll use? Do you understand, Miss Messi?
Yes, I think I understand it now. It
So
will be
that's why we are
the
looking
kg
for
times.
standard. That's the standard quantity in total. Don't forget, this is material cost. Total cost is different from price. Price is for 1 unit, right? So standard quantity for the total production times standard price, right? Now, actual quantity used. How many quantities was actually used? So this is it. Direct materials consumed for material A is 192,000. Abi? Hello?
Yes, sir.
Yes,
So the
sir.
actual quantity we used is 192,000 at actual price of 2 naira 40 kobo. Do you understand?
Yes, sir.
And the question can give you this figure, it can give it to you in total. All right, but this one has given it to us like this. Our actual quantity is how many? 192,000 kg. 192,000 kg. You can see earlier when I said 19,000 times 10 kg, it will be 190 kg, not in units. You can see that now, right? Times actual price is what? 2 naira 40 kobo. Abi,
Yes, sir.
am I right, please? Please
Yes,
hold on
sir.
a second. Hold on a second. Can you hear me, please?
Yes, sir.
So now, So that's the actual quantity times 2 naira 40 kobo, right? Are we there, please?
We are here, sir.
Okay, times 2 naira 40 kobo. And what does that give us? What does that give us, please?
460,800 naira.
For material A, this one will be 190,000 kg, Abi.
Yes,
190,000
sir.
kg times 2 naira, right?
Yes,
Minus
sir.
192,000 kg times 2 naira 40 kobo. Abi?
Yes, sir.
Hello, are we together, please?
Yes, sir.
Okay. Now, what else do we have? What will that give us? 190 times 2 is what? Now, will my answer be in naira or in kg?
In naira.
In
It
I'm
should be in
doing
naira.
Naira.
It should be
Thank
80
you,
naira.
sir.
precision now. It should be
190
80,000.
precision.
times 2 is what?
380,000.
380,000 naira.
380,000 naira minus what? 192 times 2.4.
460,800 naira.
460,000.
460,800.
Yes, sir.
And what does that give us?
80,800 naira. Adverse.
Adverse.
Advert.
8,800. So we are planning to spend how much? We plan normally we ought to spend 380, but we spent 460. That is adverse, Abi.
Yes,
Yes,
sir.
sir.
That's adverse. I can put my adverse in jacket, right? Now this is for material A. We can do the same thing for material B, Abi. Am I right, please?
Yes, sir.
Okay. So for material B, what do we have? Material B is 5 naira times what? 96,000 kg. I don't know, 19,000 units. Don't forget the
19
product we use both
19,000.
product, I mean both material A and material B. Abi,
Yes, sir.
am I right, please?
Yes, sir. 5,019.
Okay. So 5,000 times 19 naira, what do we have?
19,000 naira times 5.
19,000 kg. No, units,
I just said, yeah,
right?
90,000 times 5.
Times 5 kg times how much?
10 naira per kg.
10 naira per kg, right? Minus actual is what? 96,000 kg times 9.4,
96,000.
Abi.
Yes, sir.
Times 9.4 naira. And what will that give us, please? 19 times 5 times 10 is what? 190 times 5.
95,000 kg.
Sorry?
Nah.
95,000 kg times 10.
So it is 950 kg.
It cannot be 95. 950,000, Abi.
It is
950,000.
950,000 kg.
950,000.
Minus what? 96 times 9.4 is what?
We'll have 902,400.
902,400.
Yes, sir.
400.
Okay. And what would that give us?
We'll now have 47,600.
Favorable.
47,600.
Favorable.
47,600 favorable, right?
Yes, sir.
Yes, sir.
Material A and material B. Material A and material B. Total material cost variance. Will give us what? A is 80,000, right? No, let me use B first. 47,600 minus 80,800. What does that give us?
33,200.
Adverse,
Adverse.
Abi.
Adverse.
Yes, sir.
Adverse.
33,200 adverse. So that is what we have for our material cost variance. All right. 36,200 as material cost variance.
What if you put A, sir?
Yes,
A.
I'll definitely put A. I'll definitely put A. Any question on that, please? Any question? Any question? No question, right? Huh? Okay, I believe there is no question. Now, the next one we have is what?
Direct labor variance.
Direct labor variance. Which is labor cost variance, Abi? Labor cost variance, Abi?
Yes, sir.
Okay. So what's the labor cost variance? The same thing, right? Am I right? SS minus AA, right?
Yes, sir.
Standard hour here,
Standard
standard
rate.
hour times standard rate minus actual hour times actual rate. Abi, am I right?
Yes, sir.
Okay, so what do we have there? Yes, in the question, what do we have, please? For
5
our
hours
labor,
at
5 hours at 6 naira per hour, right? Am I
yes,
right?
sir.
Okay, so 5 hours is the standard hour for 19,000 units, right? So 5 hours times 19,000 units, Abi, multiplied by 6 naira minus what is the actual hours spent? Direct wages incurred was 92,000 hours at 6 naira 40 kobo per hour. Abi,
Yes, sir.
so we can do it the same way. Let me take this one. I am too lazy to start typing again. So please permit me to steal this one. Okay. So what's the standard hours in the question? 5 hours times 19,000, Abi. Am I right? Five
Yes, sir.
hours times
Yes,
That's
sir.
19,000 units, right? Times standard rate is what? 6
6
naira
naira per hour.
Yeah. Per hour.
minus actual hour is what? 92,000 hours at 6 naira 40 kobo. Abi,
yes, sir.
92,000 hours times 6 naira 40 kobo. Yeah, what does that give us? 19 times 5 is what?
95,000. 95,000
95,000
hours.
hours.
95,000 times 6.
We'll be having 570,000.
570,000 naira.
Naira.
500 and
70,000 naira.
70,000 naira.
okay.
570.
Minus
570. 570. 570.
okay. Minus 92,000 times 6.4 is what?
588 naira. 588,800 naira.
800. Yes, what's the difference? The difference will give us 18,800, Abby.
18,800.
Advance.
Yes, sir. Advance.
18,800 adverse.
Advance.
Adverse. So that's what we have. 18,800 adverse. Any other question, please? I believe we understand that too, right?
Yes, sir.
Okay. Then the next question, let's go into the next
Yes.
question. Overhead variance. Now, what's our overhead in the question? We have fixed production overhead, right?
Yes, sir.
Now, what's our fixed production overhead variance? We mentioned that before now, Abby. Now, for overhead variance, which is the general fixed production overhead variance, it will be budgeted fixed overhead minus the actual fixed overhead. Abby, we mentioned that earlier, right?
Yes, sir.
Fixed overhead variance. Is it budgeted? Are we using budgeted for it? No, we are using standard, right? Standard fixed production overhead variance minus actual fixed production overhead variance. Let me show you in the material because I think, yeah, this is it here. No, this is a question.
Budgeted fixed
Yeah.
overhead.
So for fixed overhead total variance, why is this one showing here?
Budgeted fixed overhead, I say. I was always.
Yeah. So for fixed overhead variance, we have it to be the fixed overhead absorbed, right? Budgeted fixed overhead and the actual fixed overhead. Now, what's our question here? So in the question given to us, we have the fixed production overhead incurred, which is the actual. Abby, am
Yes,
I
sir.
right?
Right. Yes, sir.
And they
Yes,
said that
sir.
fixed production overhead is absorbed at what?
200% of direct wages.
Direct wages, 200% of direct wages. Now, before we go into that, what is the standard fixed production overhead? If we are using direct wages is 5 hours. Abi, am I right? Maybe this is it here now.
Yes, sir.
This is the direct wages. Ma,
Yes, sir. You are right, sir.
direct wages is 5 hours. Abi, now, ordinarily, our production overhead, our fixed production overhead, we should spend 5 hours on 19,000. Right? Am I right, please?
5 hours
Yes,
on
sir.
19.
Yes, sir.
On 19,000. Now, what's our fixed overhead absorption rate? What's our fixed overhead absorption rate
100% of
Of direct wages.
of direct wages? 200% of direct
Yes, sir.
wages. So, what is our direct wages now? 6 naira. Abi?
Yeah.
200% of 6 naira is what?
200% of
12
6 naira.
naira.
12 naira.
12 naira. Right? Okay, so if that is the case, now we are saying our fixed production fixed overhead variance is standard fixed production overhead, Abi?
Yeah.
Standard fixed production overhead minus actual, right? Actual fixed production overhead. So let me write this standard in full. Standard fixed production overhead minus actual fixed production overhead. So what's the standard fixed production overhead? The standard fixed production overhead is 5 hours, Abi? Because fixed overhead is, of course, absorbed, is absorbed using direct wages, right? So we have 5 hours. 5 hours multiplied by what? 19,000 units, Abi? Times our fixed production overhead is what? Is what, Sef? Eh? 6 naira times 200 units.
12 now. 12
That's
naira.
6 naira
6
times
naira
200,
times 100 units is 12 naira.
200%, Abi?
12
That's
naira,
the
yes.
That's the standard. Minus what is the actual fixed production overhead? 580,000 naira. 580,000 naira. Now, what does this give us? 95,000 times 12 is what? Five times 19 is 95.
1,140,000.
1,140,000.
Yes, sir.
Ah, that's that's really high, yo. 1,140,000 minus actually is
Sir,
580, Abi.
are we using standard fixed production overhead or
Sorry,
budget fixed overhead, sir?
what do you say, sir?
Are we using standard fixed production overhead or budgeted fixed production overhead?
So we are using standard. Now we are using standard for fixed production overhead. In total, the cost is standard. All right. Now, if we are to use budgeted, that means they will give you what your budgeted fixed production overhead absorption rate was as well, or your fixed production overhead cost. Do you understand? They would have given you a budgeted fixed production overhead cost. Are we given?
No, sir.
We are not given the fixed production overhead cost. So that means our budget here is our standard.
Okay. Assuming we have in the case where we have budgeted, where we are giving and we still have standard. So in that
So
case,
when we have budgeted, we will use our budgeted to get our fixed production overhead absorption rate.
okay, sir.
For fixed production overhead absorption rate, it has always been budgeted, not standard. Do you understand that, sir?
Yes, sir. Thank you very much, sir.
So that is it. So what's the difference between these two? 600. Is it up to 600?
560, sir.
560,000.
Yes, sir.
Yes, sir.
Favorable or adverse?
Favorable.
Favorable.
Favorable. Do we have any other question here? Sales variance. What was our sales variance? Let's see if we can wrap up with our sales variance. This is past 9 already. Yes, what was our sales variance? Yes. What did we call our sales variance before? I said if you are using marginal costing, you are using standard contribution, right? But if you are using absorption, you are using standard profit. I mean, now for the sales variance, sales price variance, but this one is sales generally, right? Sales variance generally. What's our sales? Yes, go ahead, please. That person should go ahead.
Sir, sorry to take us back. I want to ask, in a situation whereby you said direct material cost variance, that's the material cost variance. You said it comes in rate and usage. So when
material rate and usage care.
No, that's not. So I know, like the formula you gave us first, but you said variance analysis, like you gave us. You said material, price, usage, and this thing.
Price and
Material
usage.
cost. Yes. So where are we? What kind of question what scenario can we like see that they will just ask us to solve for the three? Because they said direct material cost variance, and we just assume that it's just the cost variance alone that they ask us to solve. In what scenario can they ask us to solve the three?
The question will be very specific. Solve material price variance, solve material usage variance, or solve all the variances involved in this question. So when you see a question that says that you should solve all the variance in the question, definitely you are not looking for something else. Right?
Yes, sir.
So if you're now in this question now, okay, now this is what we'll do. For your assignment, you will do material price variance, material usage variance. When you add it together, if it gives you the material cost variance, then you are right. If it doesn't give you, then maybe you are wrong or I am wrong. For material for labor variance as well, everybody, I'm giving this as an assignment now, and you must submit it before the end of tomorrow. Right? We are not having class tomorrow, but we're having class on Wednesday. For material usage variance, for labor variance, I have solved labor cost variance, right? So for your assignment, you will solve labor rate variance. There is no price for labor. Labor rate variance and labor efficiency variance. They had the two together and it gives you the labor cost variance. That means we are both right. If it doesn't give you the same thing, that means either you are wrong or I am wrong. All right. So let's do that. The same thing to overhead variance. All right. And also you do the same thing to sales variance. Are we together, please?
Yes, sir.
Okay. So that is that. Now let's go back into our sales variance. So for our sales variance, what will it be? Standard price times standard quantity minus actual price times actual quantity. Abi? Am I right? Hello?
I don't think it was that for sales.
For our sales.
Yes, I don't think he gave us the expo.
He didn't give us the expo.
The acronyms.
Okay, I didn't give us the acronyms.
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
So I actually gave us the acronyms.
Sir, you gave us.
It's still the same thing. It's that same
Standard.
SS and AA. All right. It's still the same SS and AA. So now let's look at it. Yes. What's our standard price times standard quantity? What's the standard price of our sales? Where is the sales self? Budget and sales. Budgeted sales and production is 20,000 units. Let's leave that one. Now, actual sales. Wait, 19,000 units was sold, Abby, at a price of 15% higher than the budgeted sales. Am I right? The selling price is 15% higher than the budgeted selling price. What's the budgeted selling price? We are not given the budgeted selling price, are we? Someone should say we are not giving the budgeted selling price. Are we given?
We are giving 20% of sales price as our budgeted selling price. So 20% of sales price.
20%, no, budgeted sales price has been calculated as 20% margin. Calculated, the budgeted sales price has been calculated to give a margin of 20% of sales price, right? Hello?
Yes, sir. I agree with you, sir.
So we are saying that our selling price will give us a margin of 20%, which is a profit. What is margin? Cost on profit on sales, Abby. Am I right?
Yes, sir.
Yes, sir.
Are you sure you guys understand what I mean? What is the meaning of margin?
Margin a profit on sales.
Profit on sales. Markup is profit on cost, Abby.
Yes, sir.
So let us get the selling price. Let us know what our selling price will be. All right. Selling price is equal to what? Equal to yes. How do we get our selling price? We have the cost price, Abby. We have our cost price, Abby.
Sales minus cost price. Abi?
I'm coming on. So sales minus cost price. No, selling price is what we are looking for. We've not gotten our sales. All right. So let's get our cost price. What's the cost price? We have material. Right? Sorry. Cost price. Yes. What's our cost price? Material A. What's the cost price of material A?
I think 2 naira
2 naira.
per kg. Yes.
Okay. Material B. Material B is what?
10 naira per kg.
10 naira per kg.
10 naira per.
Sorry, Jerry. 10 naira per kg. Then labor. What's our labor? What's the cost of labor?
5 naira. Okay. Is it 5 naira or 6?
6 naira. 6 naira. No. I think 6 naira.
Someone should confirm.
6 6 naira per hour.
6 naira per hour.
6 naira per hour. I
Yes,
mean,
sir.
Yes, sir.
okay. So, now this one is per kg, not per unit. Wait, our material. How many material will make 1 unit?
10
Eh?
kg. 10 kg. Make 1 unit.
So this is what we are doing. We are doing material per unit. I mean, selling price per unit is what we want to calculate, right? Which is 10 kg times 2 naira. Abi? Am I right?
Yes, sir.
Times 2 naira. So that means this one
20 naira.
is 20 naira. Abi?
Yes, sir.
It's 20 naira. Then the other one that we have, material B is 10 naira. How
Yes,
many?
5 kg. 5 kg.
Eh?
5
5
kg.
5 kg. That will give us 50 naira.
5 kg times 10 naira.
That will give us 50 naira.
50 naira. For labor, what do we have for labor?
5 hours on 6 naira.
5 hours times 6 naira.
26 naira.
That will give us what? 30.
30 naira.
naira per hour.
What else do we have? What else do we have?
Fixed production overhead.
Fixed production overhead.
No.
How much is that fixed production overhead?
We're supposed to bring it here.
Yes, now. It is our total cost. Don't forget, the question says that whatever sales we get, profit is 20% of our sales. Before you can calculate profit, you must have considered all your total costs now.
Yes, sir.
Abi?
Yes, sir.
So fixed production overhead. How much is fixed production overhead?
5 hours on 12 naira.
500.
5 hours times 12 naira.
5 hours of 12 naira.
Yes.
And that gives us what? 5 times
60
12, 60.
60 naira.
60 naira.
Any other thing? Any other thing? Nothing, ba? Yeah, let's see what we have now.
160 naira.
Total
160
cost.
naira.
160 naira.
$160. Now, if our total cost is 160 naira, and they said our profit is 20% on margin. Now, convert 20% to markup. What do you have? This is margin. 20%. This is what they mean here. This margin is margin, Abi. Let's convert it to markup. How do we convert it to markup? How do we convert margin to markup?
Say 20 divided by 120.
Well, I had 100 to the
You add 100 to
denominator.
the
20.
markup percentage. So it will be 20 divided
Is
by
it add or
120.
you less? 100 minus 80.
100
So
minus.
adding.
Minus 20.
We got punished devil. Oh. So 20 divided by 100 minus 20. Right? So this is what we have. Yes, 20 divided by 80. 2 over 8 is what? 1 over 4. 1 over 4 is what? 25%. I mean?
Sorry, can you please recap it, sir?
Okay. 20 over 80 is what?
25.
20 over 80 is what?
0.25.
0.25. Thank you, sir. So 0.25 times 160 will give us what?
40.
4 times 4, 16. You're right, sir. Do we understand that? I have converted markup to, margin to markup. If margin is 20%, markup will be 20 divided by 100 minus 20. Right? Because it simply means that that 20 that is profit is part of the 100. So you remove it, that will be 20 divided by 80. Right? And that's what we have there. So what do we have in total now? I should not be the one teaching you how to convert markup to margin again. I hope we know that. So what's our selling price? 200. Right? Any question on that? And so this 200.
Sorry, sir. If
Hello.
now have, it's because we have margin. That's why we converted it to markup. If we have
Yes,
markup, it's now going to be 20% of 100 direct, right?
exactly. Now, why am I using markup? Why can't I use the margin straight? I'm using markup because I have the figure for the cost. Markup is profit on cost, right? So that's why I converted the margin, profit on sales, to profit on cost, since I have the cost. Now, had it been markup was given to me and I have all the costs as this 160, I would have used that same 20%, 20 over 100 straight, because 20% of that cost is my profit. All right. But the question gave us profit on sales, not on cost. So I had to convert that margin to markup. Now, whatever I get, this 200 naira is my what?
Selling price.
What type of selling price? Standard or actual?
The standard selling price.
Standard selling price. Because all the figures I used here are all standard cost. Abi? Am I right? Material,
Yes, sir.
labor, and fixed production overhead, they are all standard costs now. Are they the actual? Are they the actual?
No, they are not. No, they are not, sir.
So that's the standard cost. Now, what is my actual selling price? Now, this is my standard selling price. What is my actual selling price? The question told us that, where is it? Now, 19,000 was sold at a price of 15% higher than the budgeted selling price. So you can call this my standard selling price or budgeted selling price. Why my actual selling price? Hello? Actual selling price is what? 15% higher than this 200. That is 15% to be what? 115 divided by 100, I mean, times 200. Or you say what? 1.15
1.15 times 200.
times 200. Abi?
30 naira.
And what does that give us?
230.
You cannot
230.
get 30 naira. You get
230.
230. You will get 230 naira. So that is our actual selling price. Any question?
Sir, please, I don't understand.
Which one?
The actual selling price, sir.
What does the question say? Read the question, please. Read this production part. What does it say?
Production 19,000 units sold at a price of 15% higher than the budgeted.
Budgeted selling price. What's our budgeted selling price? We have solved it now. Is this not our budgeted selling
200,
price?
200 naira.
But you didn't say it now. So 15% of 200 naira is what?
Thirty, sir.
30. So that means the actual selling price is 30 naira higher than the budget. Is that not what the question says?
Yes, sir.
So what is your actual selling price?
230. Okay.
Yes. Any question from anyone? Eh? Any question from anyone? Okay, so let's do our sales variance, right? Hello.
Yes, sir.
So what do we have, please? What will that give us? What will it give us? So standard sales. Hello. What's the
Hello,
standard
yes, sir.
quantity?
We are with you.
What was our standard quantity? In the question, what was our standard quantity?
19,000
20,000
units.
units. Abi?
19,000
Standard
units.
quantity. Standard quantity. Budgeted sales. Budgeted quantity is here. Budgeted
20,000
and
units.
standard
20,000
is
units.
20. Is 20. Right?
Yes,
Am
correct.
I right?
Correct. Correct, sir.
So
You are
now,
correct.
if our budgeted is 20,000 units, that's the standard price or budgeted sales. Budgeted quantity is 20,000 units. Abi,
Yes,
hello.
20,000 units. Yes, sir. 20,000 units.
Budgeted quantity is 20,000 units. Abi,
Yes, sir.
Sir.
Yes, sir.
Ma? Okay. So budgeted quantity is 20,000 units times, which one are we using? Standard price or budgeted price or what? What are we using, please?
Budgeted price.
Budgeted price, which is standard price of 200, Abi. Right? Can someone hear me,
Yes, sir.
Yes,
please?
sir.
200.
200.
200.
Okay. Now, if our unit is budgeted selling price is 200, please, let's solve that question. What do we have? What do we have, please? Yes, what do we have in the question? I'm asking you.
I do not get your question,
Sir,
sir. I do
so
not get
what's
it.
the question, sir?
I'm saying we should solve this question. The last question of sales variance. What do we have on the sales variance? How do you
Budgeted
solve
sales
it?
and production for the month is 20,000 units.
Sorry? What do you say, please?
I said budgeted sales and production for the month is 20,000 units. So we're
Uh-huh.
going to do standard selling price minus actual selling price times actual quantity sold.
Ah. Oh, yeah, go ahead. Now, are you using selling price or profit?
I'm going
Selling
to use
price.
profit. I'm going to use profit. Okay.
We are using what, please? Let's bring it back to this thing. We are using what?
We are using
Selling price.
our selling price. Selling price minus
Okay.
actual selling price times actual quantity sold.
So we are using selling price or profit. Let's take it again.
Selling price.
Selling price. Don't forget, we are not doing sales price variance. So are we doing price variance?
No, sir. Wait to see.
Which one are we doing?
Sales variance.
No, we are not using sales now. We are doing the total sales variance, right? So for our total sales variance, are we using selling price or profit?
Selling price, sir.
Why are we using selling price, ma? I'm just asking. Oh, I'm not saying you are right or wrong. Oh, please. I hope you understand. And I'm not saying you are right or you are wrong. So which one are we using? Wait, oh, you guys cannot tell me you don't know. You don't know?
No, is it selling price?
It's profit
Okay,
now. It's profit.
You see,
okay.
what I don't understand now is that are you trying to ask if I'm going to use contribution? Are we asking for marginal contribution? Because I did not quite get the question yet. That's just is I
Okay, the
don't.
question is this. When you are doing total sales variance, are you using price or profit?
Well, to use profit if we are doing the total sales variance.
Do you all agree with that? Do you agree with that?
Yes, sir. We are using profit when we are doing variance.
Profit.
Okay. Okay. So let's use profit now. Someone said profit. And what's our profit? Our profit is 14 naira. Abi? Hello? Hello?
Yes,
Yes, sir. It's something error. That is the our markup.
yes, sir.
That's our
Our
profit,
markup.
Abi.
Yes.
Markup.
Now, yeah, let's see now. So what
No.
do we have? I don't understand. Someone said no again. If you have something to say, please say it. Go ahead. Eh? Hello?
Sir, continue.
I'm asking. I'm not continuing. I'm not doing anything. I'm just asking. Okay, so how about we do it this way? Hmm? Let's do our
Hello.
sales price variance. Hello. Let's do the sales price variance. What will
Hello.
be our sales price? Can you hear me? Can you hear me? Hello.
Yes, sir. We can hear you,
Okay.
sir.
Yes,
So
sir,
let's
we
do
can
our
hear you,
sales
sir.
price variance. What is our sales price variance? If you are doing sales price variance, what do we have? For sales price variance, what's the formula? And we've discussed that one today now. Why are you silent? Hello? So you guys are not saying anything. So for sales price variance, say standard price, not profit, minus actual price, Abby.
Yes, sir.
Multiply by
And
what?
Actual quantity sold.
Actual quantity. So what's our standard price? Standard selling price, Abby.
200 naira.
Let me use selling price. Let me write it in full. Standard selling price. Standard selling price is 200 naira. Right? Minus actual is what? 230. Right? Multiply by actual quantity is what? 19,000 units, Abby.
Other units.
What does that give us?
200.
30 times 19 is what?
470,000 naira.
270.
570.
570. Okay. Favorable or actual? Or adverse?
It can't be 5,000 now. 19,000.
How can it be adverse? You plan to sell something at 200 naira. You sold it at 230 naira. How can that be adverse? Answer me now. How can that be adverse?
Oh, sir, sorry, it's favorable.
Okay, that one is favorable, Abby. So yeah, let's go for the other one. Now the second one is sales what? Sales volume variance, Abby.
Yes, sir.
And what's the formula?
Budgeted quantity sold minus actual quantity sold. That's our standard profit per unit.
Okay, budgeted quantity minus actual quantity. Abby. Multiply by what?
Profit, our standard profit.
Standard profit
Yeah.
margin.
Standard profit. So what's the budgeted quantity? 20,000. Right?
Minus 19,000.
Minus actual quantity was what?
19,000.
19,000. 19,000.
40 naira.
Times what?
40 naira.
Times 40 naira. What does that give us? That's 40,000.
40,000.
But favorable or actual?
Adverse.
Adverse.
We planned on producing 20,000 and we actually produced 19,000.
We plan on selling.
Selling, I mean.
Right?
Yes.
Okay, now 570 minus 40 will give us what? 530. Abby? Hello? If I'm to get the sales variance now, I will say 570 minus 40. Abby?
Yes, sir. That's
Am I right?
Yes, sir.
So this is your assignment. Use for your sales variance. Use standard price. It is AA minus AS. I mean SS minus AA. I mean standard price times standard quantity minus actual price times actual quantity. Some of you should use price. Some of you should use profit. Whatever you get, anyone that gives you the answer, paste it to the group before. You can try that one this night, please, before you go to bed. Paste it this night before tomorrow morning. Let us see what you have. This is where we hang our boot tonight. Thank you very much for your time. Good night, everyone.
Sir, sorry, oh.
Yes, ma'am.
We didn't solve the A part of this question. Why?
And the A part is not variance. I'm sure you've done
Okay,
the A part. The A part is not variance. That was why we left it. So I'll see you all in our next class. Good night, everyone. Please don't forget, solve that question. Solve the most importantly, this sales variance. I want to see that one this night. The remaining ones, like the material price variance, material usage variance, labor hour and rate. I mean labor hour and efficiency. No. Labor rate and efficiency, right? Then the same thing for your fixed production overhead, the capacity and efficiency ratio, the capacity and efficiency. Please, let's do that and send it to the group before the end of tomorrow, right? Good night, everyone. I'll see you all in class
Sir,
on
please,
Wednesday.
before we go, which one you say we should do now? Sorry.
The sales variance, total
Okay,
sales
okay,
variance,
sir.
yes. So I'll see you all on Wednesday for our advanced variance. Good night, everyone.
Thank you, sir. God bless you.
Abel, who remember the formula for total sales variance before all of us go? Please.
Please, if you remember, send it to me. Rejoice. Send me the formula, please. Thank you.
Sorry, I didn't get you. What did I should do?
The formula for total variance.
Okay, I'll check.
Do you have it?
I'll check if it's part of the things I screenshotted.
Okay, thank you.
Okay.
Okay.
Thanks.
Okay.